My name is Hugh Agro, President and CEO of Revival Gold, joined by Santa for the season.
It's the end of year review with Santa. I think we're a bit old for that. A bit old.
Never too old for that. Never too
Never
old.
too old. Okay, good. I like your attitude. Right. I thought we'd kind of catch up because it's been a tough year, but you've done a few things which I was quite intrigued by. I want to sort of understand, how have they gone? Why did you do them? And then maybe does that set you up any better for 2025, irrespective of whatever you think the gold price is going to do? So first of all, let's remind people of, what you've got, what you had at the start of the year.
Thanks. Super. Transformative year for us in 2024. We started the year with Beartrack-Arnett, our Idaho project, and now 4.6 million ounces of gold. But really, there were some questions from the market around, well, how quickly can you get that into production? And we responded to that. We went out and after looking at a number of dozens of projects in the production stage, in the development, in the exploration stage, we found a great fit for us, the Mercur project in Utah, neighboring state, so operational synergies for us. But really importantly, this is on a resource that's on private patented land claims. So that is something that we can move more quickly through the development stage and into production. We're working on a PEA right now on that project. But the other thing about it is that it really fits well with Revival Gold's strategy and approach of pursuing brownfields projects where gold has been successfully mined before. Then that means we've got infrastructure, power line, road, water access, lots of technical data, which saves us money, but importantly, it also saves us time. So when we think about taking these development projects into production, we're talking about less time because we have more of those linear items for operation already in place and less risk. We always look at that IRR number, but we don't really talk a lot about the risk related to that IRR number. And so by having that technical insight and understanding, we lower risk. So transformative year for Revival Gold in 2024. We've now got two projects, 6.2 million ounces, both in the Western United States, both on brownfield sites where we have this infrastructure advantage, lowering risk, lowering cost, and lowering time to free cash flow.
Okay, well, I think you hit the nail on the head here. I think the companies that are getting rewarded, certainly that we're seeing, the companies that are getting rewarded are producers because it's a high-priced gold environment, and hopefully a better margin environment because that's the key thing here, and that gives them optionality in terms of what they do with their cash, buybacks, dividends, acquisitions, or just bank it, whatever they feel is the right thing to do. Or near-term stories, near-term production stories, where companies are able to credibly say, we can very quickly get into production. Everyone else seems to be left behind. And maybe we can talk about that in a second, because people I think have to be quite creative and come up with alternative financing.
I just want to, before you hit me with the question, Matt.
Okay.
I just want to make this is an important differentiating thing because everybody's looking for free cash flow assets. The reality is there's not a lot of them out there, and there is very little equity financing to fund these things. So let's be very clear here. We're trying to build value in the underlying stock, and that doesn't necessarily come by buying a free cash flow asset where you've had to pay for it with debt, converts, offtake agreements, hedging, the covenants and restrictions that come with it. It's a multi-dimensional chess game we're playing here. We're trying to put together assets that take us on a quicker path to free cash flow. But I think if we venture into assets that don't have scope and scale for something meaningful, so ounce potential, big deposit geology, and if we finance these things in a way that dilutes the long-term potential for equity holders, then I think we're doing ourselves a disfavor. So I just wanted to qualify that because it's easy to say, look, we're all looking for production assets to satisfy the demand for free cash flow, and away we go. It's not quite
No,
as
I hear you, and I think what we're seeing in the marketplace is that producers are buying producers because it's low risk, right? I don't think it's necessarily smart because it's high cost. The cost of they have cash, so therefore that's one way of spending your money, and there's not a high cost of that cash. So they don't need to borrow it. But for developers who want to sort of jump, get to that point where they can sort of see the same sorts of returns that producers are, they're going to have to think about how they get there. There's the ability to do deals at all because there's not a lot of good stuff out there and everyone's after the same stuff. And then there's the cost of that capital to either make that acquisition. Can you do it with paper trade? That would be great if you could. Can you get management teams to agree what their roles are, or say bye-bye to some people if they're comfortable with that? I think companies like yours need to demonstrate to the market that they've kind of got a plan, right? We've got a plan, and the plan is to get into production. And let me explain that plan to you. Now, you've touched upon some of the things that you're doing. Obviously, with Beartrack-Arnett, it's got a PFS. Yeah, with Mercur, you're talking about doing the PEA on that one. But time is the thing which it does no one any favors in a market like this. So how are you putting that plan together, and why is this the best allocation of your time, what money you've got, and the ability to allow you to raise money against what this plan is? Can you sort of talk us through your thinking for what you did in 2024?
Yeah, I'd say there's two things: minimizing the time to being sustainable, so free cash flow, but also minimizing the equity dilution and the constraints to the business that come with the inevitable requirement for funding, right? So there are two things that we're trying to triangulate on here, and so I think we've done that this year in a couple of different ways. Number one, with respect to the Mercur acquisition, private property, another brownfield sites, something that we can move more quickly to free cash flow because we're going to be in a largely state-run permitting process. The other thing about this site, of lesser importance than being on patented ground, but still very important, is that it's a dry site. So we don't have to worry about 3 years of data collection for water studies. As we look at things at this point in time, this is going to be pretty straightforward. Now, we're working through the PEA, and alongside of that, in parallel with that, we're also working through permitting schedule and steps. And so we'll have more to say about that when we complete those initiatives at the end of the first quarter next year. The other thing we've done, and again, and this is switching 180 degrees to the other side of the coin here, which is about exploration potential. And I spoke earlier about this. It's really important that we have projects with scale. Scale matters because scale is what attracts larger institutions and corporates to companies like ours. And so we've built on our exploration story at Beartrack-Arnett. We've done a lot of business case building around drill targets, structural modeling, geophysics, geochem, and our this year we transitioned to our exploration leadership to a gentleman by the name of Dan Pace, our chief geologist, co-discoverer of the Silicon project in Nevada. This is AngloGold's big North American multi-million ounce project. Dan is a proven discoverer. He's a strongly data-driven, which is where all the smart people in the corporates and the larger institutions are going with their geoscience. And I think this is a step that's really going to vault our exploration story and business case into a new paradigm. So that's a big step for us. Norm Pritchard joined our board, former president and CEO of Eldorado Gold, bringing us more of that production capability, development capability, and no-nonsense approach to development, joining our technical team as we build up that capability to move forward into development, production. And the other thing that we've done just generally with the business is we've really focused our money on the development aspects, the permitting and engineering aspects, We've shied away from diluting our share base with exploration drilling that isn't getting rewarded in this market. We're already at 6.2 million ounces of gold between the two projects, and I don't see any immediate need right away to add more resource to these compelling projects. We've only got, here are the metrics. We've only got 20% of our resource currently in a economic study. We've got $170 million of NAV out of that 20% of the resource. Imagine what we can do by bringing our Mercur project into an economic study. Imagine what we can do if we think about the third and fourth phases of our projects. So lots of value creation just from moving current resource inventory into NAV, and that's where we're focusing our dollars.
Okay, I was hoping you'd go there, because I don't think pure play exploration on top of 6.2 million ounces does anything for you in this market. And I'm intrigued by the way that CEOs and the boards are reading the market, because the way things used to work aren't working right now. I've been saying that for 4 years in the precious metal space. But I'm intrigued by companies like, I spoke with one this week, I think it was like Vista Gold, right? They had $1 billion $1 billion capex on 100 million market cap. And you're like, well, that doesn't compute. That is not getting funded. That's not getting built. So they've reduced it down to 400 million capex. And you go, well, I'm not even sure that gets done, but hey, nice start. People like Cabral Gold, same thing. You've gone from district-wide potentialist and explorer to actually sought that. We're going to have to get after some of this, cheap heap leach stuff, right? So the thinking is important to me. So when you start, I just want to say, because I know your team and I know your track record and I know you know what you're doing, but I need to hear you explain to people why you picked this. Of all the assets you could have gone, given your CV, given your track record, why Beartrack-Arnett is going to get built, and you're not just going through some, what I see 9 times out of 10, an exploration, hope and a prayer type story. So what is it that says to you this thing gets built?
Yeah, it's because of my background and experience, and what I know is that to your earlier point, $1 billion project on a $60 million market cap is an awful tough thing to deliver. So we took a page. This is going back not just 4 years ago, but going back to the founding of Revival Gold. We took a page from the Australian model of build in a phased approach. So when we talk about a PFS on our Beartrack-Arnett projects for 65,000 ounces, some people say, hey, why are you bothering doing that when you've got 4.6 million ounces resource? And the reason is because the capital on that project is $109 million. It's not $1 billion. And we can grow sequentially into the next and subsequent phases for lower capital through self-generated cash flow and for lower risk. And so that's our approach. We can translate that also into Mercur. Here we've got 1.6 million ounces of resource. We're working away now on that PEA. It's going to be relatively modest. We don't see the capital being more than 200 million. Production will be plus or minus 80,000 ounces a year from heap leach. It's a relatively straightforward thing. It's been done before on this project. And that's the way we create value for shareholders. We don't create value for shareholders by buying a producing asset for top dollar and operating that asset and returning the cash flow we used to buy it. We certainly don't do that by buying a small or short-lived or asset that lacks scale for debt and trying to deliver value back to our shareholders. I think that's short-term gain for long-term pain. The way, going back to my background, my experience, I think the way we create value for our investors, and the reason I'm so excited about 2025 in a rising gold price environment when these projects are so scarce, is that we've put a fence around 2 assets in the Western United States, great location, great path to free cash flow, credible path to free cash flow, and we've done it with very little cost to investors. We're talking about 200 million shares outstanding, no long-term debt. It's a really good construct for value creation. The value creation comes though from the hard work of finding, developing, engineering these projects, and that's how you create money in the and value in the sector. And that's what I've learned in the 35 years that I've been in this business. I look to what Alan Carter's doing. I think it's a very good approach. I think we're in alignment on this approach that if you can get these projects into operation for a limited amount of capital, and still, and Alan's a great and very successful explorationist, so he knows scale matters. So he's not just trying to develop some small heap leach operation or mill operation that's got a limited mine life and future. He's building something that can phase into a bigger potential because he sees that potential. And likewise, what we're doing at Revival Gold on 2 projects in the Western United States is a phased approach on assets with scale.
Right, I agree with you, Alan at Cabral. First of all, I think that was super smart and needed to be done because whatever was going on before just wasn't kind of working for him, and it was expensive and dilutive. You guys, back to you guys. I think that you've got something good here, but timing. Right, come back and help me on this one, because if we talk about a typical project, your PFS with one, PEA at the other, it still feels a long ways away from you getting to that point. I appreciate it's the most efficient use of capital, but if you're not getting rewarded in the market right now, you've got to say to market, look, trust us, we'll kind of go through the phases properly, and that's the best way to do it. Or you say, look, we can accelerate this because it's such a simple heap leach type project being done before on site with all of this infrastructure, low capex. It's unlikely to fall over because we know what we're doing. How would you pitch it in a room full of investors?
Well, I just point to the scarcity of producing assets, right? So Eleanor has just gone for $800 million. Musselwhite, I think $850 million. We've got a portfolio for 60 million Canadian right now. Yes, it's going to take more money to get to a point where it can turn the shovel. But we've got a portfolio of assets that can deliver that kind of scale in resource and a lot more, and that kind of scale in terms of production, trading at a fraction of the value of what it's worth. And remember, these are North American assets, and yes, it's going to take us plus or minus 3 years to get there. I understand that that's a challenge for some, but as we think about the timelines, the scarcity of these projects, and what gold's done, just look at what gold's done over the last 3 years. The very different thing between what we do and somebody who manufactures widgets, or we're still some kind of a technology product, is that our asset just goes up with time, goes up in value with time. The value of the gold in the ground only goes up. We're not producing something that will depreciate in value, and so time is really on our side. In a lot of respects, in the last cycle, we saw some of our great entrepreneurs in the gold business actually hold on to their gold because they saw that the investors were looking for that capital appreciation from the gold that they produced going into the future. So unlike a lot of other businesses, our assets go up in value with time, and that puts time on our side.
It puts time on your side as long as you can persuade people of that of that story, and you can get money to keep things moving along. As you say, it's not there yet. You're going to need to raise money. It's difficult. We've talked about a couple of examples of the ways that people are doing things. I mean, what do you feel that you've got to do? What are the options available to you? Do things change next year?
First of all, we can't depend on them changing. We can't bet on the gold price going up. So in the immediate term, we keep highly focused on things that can deliver value in the very short term. And we keep our spend down. And if we continue to be in a bad market in 2025, we can keep this business going. Our G&A runs at less than 2 million Canadian a year. The rest of our costs keep the property position together and our team together. I mean, we can deliver the whole thing for plus or minus 4 million Canadian a year, and we'll preserve the value in our stock and the value of the gold in the ground by not diluting if needs be. I happen to believe that the portfolio we've built, the scarcity of the kind of assets we provide, are going to attract and continue to attract capital. We've got some of the best investors in the space. About 40% of our ownership is in the hands of the likes of Donald Smith, Sun Valley Gold, Gold 2000, Conwave. I mean, these are sophisticated institutional owners who are in for the long run with our company, and I think they get it. I think the corporates that are watching our progress get it, and it's just a matter of being patient, doing good work, and preserving our capital structure while we go through rough patches in the market.
Okay, I never ask anyone to can predict the price of gold, but we've got Goldman's predicting 3,000 next year. It seems like there's no end to this gold frenzy that we see ourselves in. That's, see, we've talked about it, helping producers. Does it help with conversations when, not just for your current shareholders, when you are doing these non-deal roadshows or you're talking to, these institutions that you would like to be looking in at you? What does that conversation look like?
It's fascinating. The retail audience, particularly in the U.S., gets it. They get it. We're having our story is resonating very well with the domestic U.S. market. I guess it makes sense because we've got domestic assets. But look at what's happening at the local Costco in the United States. It's selling a ton of gold, silver, platinum even, and it's selling out of those metals. There's a lot of appetite for exposure to the metals. We're not seeing it in the institutions. The common refrain we hear from the institutions is, gosh, the price of gold goes up. All that happens for us is that investors want to liquidate their winnings and go invest in the next Nvidia. But I think that turns. And for anybody who's been through a cycle, again, going back to my experience in 2000, what we saw was very dramatically over the course of 2 or 3 years, the development space got hollowed out. Everybody was too busy with the dot-coms. And, we had a rollover of the market on historically low metal prices in the early 2000s. And then once the equity market started to come back and the generalists realized that they were missing out on returns by being light on precious metals holding, on commodities holdings, they came in with a vengeance and the market took off. And what happens in these senior gold companies in particular is they scramble around to try and find assets. They scramble to find a seat on the bus. There aren't enough seats. And then you get the crazy exuberance, which is the sign of a toppy market. And that's when we all go home and take our winnings off the table. It's not here yet, but I think the stage is set. And if we mind our knitting, do good work with putting these projects together, we will be rewarded. And I feel very excited about 2025, not just because of the steps we've taken in 2024 to adapt, your point, Matt, to adapt to the market conditions, but really from the foundational steps when we first got Revival Gold started, this phased approach, staying in good geography, focusing on scale, all of those things matter to, and when the inevitable music stops and people are looking for places to sit, we're going to have a really hot story here for the market. We've got to bide our time, but we're on the right path.
Okay, so I think there's no debate that the thematic is hot at the moment, but there's also a lot of competition. People usually like to throw out cryptocurrency or the green energy investments as a major competitive problem for precious metals. Certainly the last few years. I'm sort of looking to understand more about the risk profile of the space, right? So if I'm looking in new money looking in, and we need new money in this space because a lot of the institutional money has exited, left. They've had a lot of value destruction there. We've seen at the beginning of this year, end of last year, a few operational mishaps along the way. We've seen a lot of economic study blowups, and clearly as a result, we've seen a huge problem with financing. As right, the bulk of what we've talked about today. So you've worked in majors. You've been party to groups of built mines, in discoveries, expert. You've kind of seen it all, right? What are the things which stop those operational concerns, mitigate the operational concerns of investors? What do I need to see in a company which allows me to feel, actually, this is in good hands, it will work?
Well, it starts with people. There's some really good teams out there. One thing I'd say generally to investors today is that if there are teams that have survived the last half a dozen years and thrived through those periods and made progress, those are teams worth backing for the next 6 or dozen years, because they've survived a lot of challenges to get to where they've got to. But I think, Matt, it starts with the team. And rather than bore you with all the details on our team, I'd encourage people to go to our website and see the depth of the experience, not just in discovery, but in operations, in mining that we have. I think the other aspect of it, though, is choosing projects that are relatively simple and straightforward, right? So we don't want to carve out really complicated things for a new business. It just compounds on itself. And, our great neighbors next door to us at Perpetua, with the wonderful Sibnite project, world-class in scale and size, but very complicated on a complicated site with a complicated process, with very complicated logistics and infrastructure requirements. So now just rounding the corner on permitting, and at precisely the right moment here with strategic metals being in focus in the United States. I think a simpler project, a heap leach project, one in a dry location, one on private ground, one that's been operated before with the same process in a very similar fashion, takes away a lot of risk and complexity. And so that's the other aspect of this that goes along with it, is the project. And then I think the third piece is access to capital. And you never can have enough long-term capital. And I think what's intriguing, your earlier observation about some of these transactions that have taken place, is that it's not been the North American financiers, the institutions that have really taken these assets. It's been offshore. And I think there's a recognition in other parts of the world, non-North American parts of the world, non-Western parts of the world, that these assets have a lot of value. And there's a lot of money in those quarters. And they too, unlike in the cycle in the 2000s, I think they too are going to be playing hard. China, Indonesian interests, Egyptian interests, Turkish interests, all clamoring for exposure to North American, South American, North American, Western assets.
Well, it's going to need it. It's definitely going to need it. Otherwise, I think the exploration side of this equation will go missing, and that's going to have a massive knock-on effect. You could argue great scarcity of metal means higher prices, but I think for the long term, it's not good for the sector at all. Okay, well there we go. A robust analysis of what you've done and what you're going to be doing. For 2025, you sound optimistic. You sound pumped up, ready to go.
Yeah,
are your shareholders? Do you feel?
I am. I'll tell you what. I'm a lot more excited about where we are at the end of this year than I was at the end of last year, and I'm also grateful. And just sort of in theme with the year end, Matt, I want to say thank you to you, your viewership, your audience, your community. It's really important that we have functioning communications and communities of investors that are part of this story and that are successful. And so we really appreciate the partnership with Crux investors. Thank you.